If you are wondering what the Fed rate cut means for your portfolio and how to make the most out of this cycle, you're in the right place. In this video, we will discuss 3 sectors that benefit the most from this shift. Plus, we will highlight some stocks you need to keep on your radar as these sectors prepare to take off. At the end, we will discuss the market performance in the past rate cuts and see what we can learn from it. Before diving into these 3 sectors, let's see what a rate cut is. A rate cut happens when the Federal Reserve, or the Fed, lowers the federal funds rate. This is the interest rate at which banks lend to each other overnight. It serves as a benchmark for many other rates in the market, including loans, mortgages, and credit cards. A lower federal funds rate means it becomes cheaper for banks to borrow, and they often pass those savings on to businesses and consumers through lower borrowing costs. For investors, this means companies can expand easily and consumers may spend more, both of which can boost stock prices and drive market growth. First up is the real estate sector, which historically sees significant benefits from lower interest rates. When the Federal Reserve cuts rates, borrowing costs for real estate developers and investors decrease. This is critical for real estate companies, as their growth often depends on leveraging debt to fund property acquisitions, new developments, and renovations. For example, real estate companies typically borrow millions or even billions of dollars for large-scale projects, and an interest rate drop of just 0.5% can reduce annual interest expenses by millions, freeing up significant cash flow for expansion or improving existing properties. Within the real estate sector, 2 key types of REITs stand out: residential and industrial REITs. Residential REITs focus on owning and operating apartment complexes, single-family rentals, and other housing properties. These REITs benefit when mortgage rates fall, as demand for housing tends to rise, pushing up both rental prices and property values. On the other hand, industrial REITs focus on warehouses, logistics centers, and manufacturing spaces, benefiting from the growth of e-commerce and the increasing need for supply chain infrastructure. One great example of residential REITs is Essex Property Trust, ticker symbol ESS. Essex manages apartment communities along the West Coast, particularly in high-demand markets like California and Washington. In these states, the cost of home ownership remains high, meaning that even with lower mortgage rates, many people continue to rent. The strong rental demand allows Essex to charge premium rents in the markets. During the 2019 rate cut cycle, Essex performed exceptionally well, with its stock price rising by over 30% in the months following the cuts. The current dividend yield is 3.11%, and the dividend growth rate was 6.80% in the past 10 years. The share price appreciation was 5.63% per year in the past 10 years. A $10,000 investment after 10 years would become $21,522 with an annual dividend of $743. In 20 years, the investment would be $52,229 and the annual dividend would be $2,026. In 30 years, the investment would be $132,059. Now the annual dividend is $5,755. On the industrial side, Prologis, with ticker symbol PLD, stands out as a leader in logistic real estate. With warehouses and distribution centers that serve the needs of global e-commerce giants, this REIT benefits directly from falling interest rates by reducing its financing costs for large-scale acquisitions and developments. As demand for logistics and warehouse space grows, particularly from companies like Amazon, Prologis is in a strong position to capture market share. During the 2019 rate cut cycle, Prologis saw its stock price increase over 40%, driven by its ability to access cheaper capital. The current dividend yield is 2.97%, and the dividend growth rate was 11.44% in the past 10 years. The share price appreciation was 13.01% in the past 10 years. A $10,000 investment after 10 years would become $37,444 with an annual dividend of $964. In 20 years, this investment would be $156,985, and the annual dividend would be $3,452. In 30 years, this investment would be $638,396, and the annual dividend would be $11,982. Next, we have the utility sector, which often sees substantial benefits during a rate cut cycle. Utilities are known for their stability and consistent demand, providing essential services like electricity, water, and natural gas. However, they are also capital-intensive businesses that rely heavily on debt to finance infrastructure projects, such as building new power plants, upgrading transmission lines, or expanding renewable energy facilities. A rate cut leads to significant savings on interest payments. It further frees up capital for further investment in infrastructure and innovation. It also helps maintain steady cash flow, which will benefit investors in the form of dividends. One standout utility stock to consider is NextEra Energy with ticker symbol NEE. This is the largest utility company in the world by market capitalization. Based in Florida, NextEra operates Florida Power and Light, which serves millions of customers in one of the fastest-growing states in the U.S. NextEra has aggressive investment in renewable energy projects, with plans to continue expanding its renewable portfolio over the coming decades. The company's expertise in managing large-scale renewable energy projects allows it to generate power more efficiently at a lower cost. With a long history of delivering consistent returns and a stable growing dividend, NextEra has established itself as a reliable investment in both the traditional utility space and the rapidly growing renewable energy sector. The current dividend yield is 2.44%, and the dividend growth rate was 11% in the past 10 years. The share price appreciation was 12.65% per year in the past 10 years. A $10,000 investment after 10 years would become $35,000 with an annual dividend of $735. In 20 years, this investment would be $136,762, and the annual dividend would be $2,433. In 30 years, this investment would be $520,612, and the annual dividend would be $7,841. Finally, we have the consumer discretionary sector, which often sees a boost during periods of lower interest rates. Consumer discretionary companies sell non-essential goods and services. Think of things like cars, entertainment, travel, and luxury items. When interest rates fall, borrowing becomes cheaper not only for businesses, but also for consumers, who can access loans for major purchases, like cars or home renovations, at more attractive rates. For example, when consumers can finance big-ticket items at lower interest rates, we often see an uptick in sales of products like automobiles, electronics, and travel services. A great example in this sector is TJX Companies, ticker symbol TJX. It is the parent company of popular off-price rental chains like TJ Maxx, Marshalls, and Home Goods. TJX benefits in two major ways. First, when interest rates fall, consumers often feel more confident about spending, particularly on discounted apparel and home goods, which drives traffic to TJX stores. Second, this business model thrives on offering high-quality products at discounted prices, making it a go-to destination during periods when consumers are looking to stretch their budgets. In fact, during the last rate cut cycle in 2019, TJX stock rose by over 25%. as increased foot traffic and value-seeking consumers help boost the company's sales. The current dividend yield is 1.27%. While this number is not very impressive, the dividend growth was at an impressive rate of 16.03% per year in the past 10 years. The share price appreciation was very high at 14.69% per year in the past 10 years. A $10,000 investment after 10 years would become $38,119 with an annual dividend of $546. In 20 years, this investment would be $171,245, and the annual dividend would be $2,801. In 30 years, this investment would be $783,752, and the annual dividend would be $14,643. So, what can we expect after the rate cut? Historically, we have seen that rate cuts sometimes precede market crashes. For example, in 2007, the Fed began cutting rates in response to signs of economic slowdown. Initially, the market rallied, but we all know what followed: the housing crisis. Similarly, after the dot-com bubble burst in the early 2000s, the Fed slashed rates, but the market continued to decline as the economy struggled to regain momentum. These events show that rate cuts aren't always a signal of smooth sailing. They often come when the economy is on shaky ground, which could lead to volatility or even a downturn. Now, we are not able to predict whether the market will crash in the coming years, but we can always get ready for it. In summary, the rate cut could serve as a catalyst for growth in certain sectors, but your investment strategy should remain centered on long-term quality investments. Thanks for watching. Be sure to hit the like and subscribe button for more helpful tips like this. See you in the next video.